Thanks for joining us on Parlance. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get you the headlines. Indian markets trade near the day's highs, led by gains in banking stocks. Tata Motors is among the top gainers after US sales rise for Jaguar Land Rover.
Investors flock to safe haven like gold to seek cover. The yellow metals prices crossed $1,300 an ounce.
A parliamentary panel suggests relaxing Basel III norms and mandatory capital reserve norms to boost lending.
Apple stock posted sharpest plunge in 5 years after the iPhone maker cuts its first quarter revenue forecast, citing slowdown in the Chinese markets.
All that coming up on the show, but let's start with the markets as always. Darshan Mehta is here with us.
Yeah, so the scare that we had in the morning is not there with the US markets falling. We are at the day's highest point of the day. And if you see sector-wise, all the sectors except for IT, which is down over 1% in trade, all of them are doing well. And IT also is the mid-cap IT that is falling significantly in trade. A couple of buckets, I think the telecom bucket is doing well. You have Bharti Infratel, Bharti Airtel doing well in today's trade. The smaller private sector banks are doing well. You have your Karnataka Bank, Federal Bank, which is doing well. Some of the PSUs like Punjab National Bank is doing well. Tata Motors over the past few days has actually started to pick up momentum. So there is traction there. What is not doing well, a couple of counters which have been dropping for the past few days. Page Industries is the big example. It's down another 4% in trade today. It's corrected all the way from levels of 36,000 now at 22,000. Tata Elxsi mid-cap IT is not doing well. United Spirits is not doing well. And Jet Airways is also not doing well. So overall, except for a select few pockets and select few counters which have managed to rally or a high value, I think the entire market seems to be doing well at this point of time. Some counters which have gained significantly include Vatek, Vabag, Serra Sanitary, but the gains aren't that high, 3 to 4% among the smaller mid caps also. So there is a traction that's happening there. But nevertheless, it's a day in which the gainers are outperforming the losers today.
Darshan, thank you so much for that. Indian markets will outperform others but not give stellar returns. That's according to Samir Arora of Helios Capital. He remains as bullish as ever on private banks but has started to short automakers. Listen in.
We are net maybe zero, maybe net negative because we short also many stocks. And so one of the bigger stocks that have fallen this year in 3 days, we have a big short position. So in general, the thing is that we still have Maruti, but mostly we are short everything else. And it is a reflection of the fact that there was a weak festive season and generally whatever else you've read that, inventories are high and that NBFCs created some issue and maybe oil prices at that time in September, October were high. Who knows? Generally, it does reflect that there is not been a very good season. But again, if the rural economy improves and in general things improve, it'll be all right. I don't think it's a hot sector and worthy of too much attention in a portfolio beyond 5-7%, even if somebody has. Nobody's going to have 15% in auto anyway, I think. But with auto ancillaries and maybe some others, you can have a little bit higher weightage than 5-7. So it's just one of the smaller sectors actually, but it's a reflection of the fact that the consumer has not been very strong.
So if autos, according to you, is the smaller sector probably, where is the larger concentration now and how do dynamics change out there?
The best thing in India is that we have a very good financial sector. If you see the private sector banks, which I've been saying for only 20 years, and one of these stocks have only 1,000 times since then, but still these are the best because they take you where the growth is. And that is the best thing about these 2-3 stocks, that if there is growth in auto, they will finance auto, and if there is growth in mortgage, they'll become there or indirectly, or if there is in personal consumption, or if somebody changes to corporate growth, it'll take you there also. So you don't have to overly worry yourself that right now, Apple phones are selling, but I don't have a way of playing Apple. Okay, so they'll be funding Apple phones there if that was happening, which it is not these days in regard to Apple phones. But what I mean is, so we always have liked private sector financials as a number one theme, private sector banks as the number one theme, and it's been with us for maybe 15-18 years.
Interesting. Samir, so your view on financials, and I'm guessing banks didn't change too much, but your view on financials, has it changed post IL&FS? Is there a version 1.0 and version 2.0 pre and post IL&FS?
Yeah, but before that, even in private sector banks, it has changed a little bit in the last 5-6 months, as in now we also own 2 corporate banks. Because, some of these things are not because anybody has changed and the management, which they may have changed and they have changed, but it's just time. Because the NPAs you can only create if you lend to corporate long gestation projects, and those projects have not been there. So your ability to make those kind of big chunky bets and then fail on them have come down, and then time also has taught everybody what to do in that sense. So that has changed in our private sector bank exposure. We don't reduce, you just add it to new names. And on NBFCs, we have now 1 or 2 shorts also, which we never had for 4-5 years that we were. So we used to have around, in the good old days till August, maybe 13-14% in NBFCs, 4-5 of them. And now, and no shorts. And now with shorts, we might have maybe 6-7%. So that way, yes, it has changed. And the reason for that is that we are still, even though all these companies will in the end survive with dignity, the issue is we don't know how the market will now react to the fact that you have survived, but your earnings have changed, your growth has changed, your model going forward has changed. And so that reset, even we don't know exactly at what, numbers or levels will everything become like a new round of NBFC growth. But they will all survive and they will all do well. But this readjustment will take some time.
The largest multiplex chain in the country continues to widen its lead over its closest rival. Be it presence, popularity or pricing power, PVR is at a significant premium to INOX Leisure. And this is reflecting in stock prices as well. Darshan Mehta is standing by with the comparison.
Yeah, so basically most of them did well in the start of the year, then actually fell in trade and they were trading in negative. Then in October, the move started. What happened was by November, PVR started to move into the green and the gap between PVR and INOX Leisure did widen. So while INOX Leisure from the start of the year is down almost 10%, PVR has managed to move up 10%. So the gap is widening. Now we find out what are the key reasons why this outperformance has come in. But firstly, a comparison of what it is. PVR, including the recently acquired SPI, owns almost 711 screens compared to 542. The number of footfalls is much more and the occupancy rate is also much more for PVR as compared to INOX Leisure. The second part is the fact that they acquired SPI in SPI Cinemas in southern India. They acquired 72% stake, and because of this, the presence in South India is 246 screens against INOX 118 screens, which is giving them a strong foothold and a bigger advantage in the South Indian market. So that is the first reason. Again, if you're looking at some of the comparative analysis of so if you want to bring it to a common denominator, let's bring it up to per screen. So the advertisement revenue per screen for a PVR is almost 11 lakhs while compared to 7 lakhs. The F&B is almost 10 lakhs higher per screen for PVR compared to INOX, and even financially per screen the next box office correction is almost 53 lakhs compared to 38. So on all parameters, on a common base, PVR seems to be doing well. The other factors that we want to talk about is despite pricier tickets, average ticket per is almost 211 compared to 195. The footfalls and the spend per head is much higher at PVR as compared to INOX, and that's why the lead is actually widening for PVR compared to INOX. The margins also, except for a first quarter when both of them had close to 20% margin, PVR margins are much more superior as compared to INOX, because as we pointed out, the F&B revenues that you saw, the F&B revenues are a high margin business, and that is a 10 lakh rupee difference per screen, and that is also causing a big difference between the two. So that's some of the key trends. The capex plan, 750 crores is something that they plan to raise by institutional investors. INOX capex plan is much lower at 173, and that probably will happen via preferential issue. Finally, what are the brokerage house saying on PVR and INOX? On PVR, 72% have a buy, but the potential return rating as per Bloomberg is negligible. It's flat return. For INOX, the number of analysts recommending a buy is much higher. Almost 92% of the analysts recommend a buy, but the return potential is 11%. But as of now, given the valuation, which is much expensive for PVR, and the outperformance is much more than PVR, the stock continues to do well even despite all those parameters.
Darshan, thank you so much for that. Let's move on now. A parliamentary committee has suggested suspending the new international accounting standards for Indian banks and extending the deadline to implement Basel III norms. The committee argues that the stringent capital requirement drastically curbs the lending capacity of banks. Nikunjori reports.
The Parliamentary Standing Committee on Finance has suggested suspending the international accounting standards for Indian banks and has also suggested extending the deadline for implementing the Basel III norms for Indian banks. According to the Parliamentary Standing Committee on Finance, higher capital requirement for banks due to the new IFRS norms and also Basel III norms will drastically impact the banks' lending abilities. The views of Parliamentary Standing Committee on Finance are similar to that of the government when it comes to capital requirements by the banks, and the panel has also said that the Basel III norms or the capital requirements for Indian banks need to be in line with global standards and shouldn't be higher than that. The Parliamentary Standing Committee on Finance has also suggested that the RBI needs to constantly monitor 11 public sector banks that currently come under the Prompt Corrective Action Framework, and has also suggested that the government and the RBI both need to relook at the PCA framework, especially when it comes to prohibiting retail banking. Besides this, the parliamentary panel has also suggested that a high-powered committee be constituted to look into whether RBI needs more powers to regulate public sector banks or not. Remember, there was a tussle between the RBI and the government when the PNB scam broke out, and the RBI had said that it needs more powers to regulate PSBs, but the government had said that the RBI already has enough powers to regulate public sector banks. So now the panel has suggested constituting a high-powered panel which will look into this, and also various other sections of the Banking Regulation Act, and also statutes which need to ensure accountability of the RBI as a regulator.
Regulators need to do more to build a healthy bond market in the country, says NSE MD and CEO Vikram Limaye. He says that SEBI circular mandating large corporates to raise at least 25% of their borrowings from the bond market is just the first step. It's the other regulators like PFRDA and IRDAI who have to amend their regulations and grant insurers and pension funds greater access to invest in the bond markets. Listen in.
There is a lot more to be done for development of bond markets, and there are various things that are already in the works to develop the bond markets. It's exceedingly important for us to develop that. And while the regulators certainly come up with a norm that says that 25% of incremental borrowings for large corporates should come from the bond market, I think it's important to make sure that various other things fall into place for that to happen, and therefore I think various other regulators also have to pull together in the right direction at the same speed, etc. Right now, for instance, if you look at the insurance and pension companies, they're restricted to invest in only AA and higher in terms of debt financing in the bond market.
The regulator has said to start out AA and higher.
Yeah, so but I think if you were to broaden that out, you will require companies that are less than AA rated to be able to also access the bond market. Because as I said, you cannot grow at 9-10% rates if you're going to be dependent only on bank financing. So you need various other companies also that are not AA rated to be able to access the debt markets. And so we need to look at a more broader framework where companies that are lower rated, they're certainly investment grade. I mean, even a single A company is an investment grade company, is able to access the bond markets. It's only then that you will get a broader range of companies tapping into the bond market.
There's a big transition happening in the derivatives market as well, cash market to physical settlement by October. Do you see that having any impact on the volumes going forward, at least in the short term?
No, I think, ultimately we'll see how things develop. I mean, I don't want to predict markets, but
based on the experience of 46 stocks which already...
Based on the experience of 46 stocks, I mean, that's been a mixed bag. We are still analyzing the experience of those 46 stocks. And so we'll see how things develop. I mean, at the end of the day, SEBI has come out with a regulation that everything will be physically settled, and therefore we'll have to see how it develops going forward.
Won't there be an arbitrage between us and Singapore, because they also SGX also launched 50 stock futures, which is cash settled, right?
No, I don't think, because the volumes in single stock futures in SGX are actually quite small. And if you look at it even internationally, for instance, if you look at CBOE or you look at the US markets, their contracts are physically settled. So it's not that they're all cash settled contracts. And the regulator has said for some time that they would like to move to a physically settled method of operating, not only in the equity markets but also in the commodities markets. And therefore, all the contracts that we're launching are also all physically settled. They're not cash settled contracts. And existing cash settled contracts and commodities are also expected to transition to physically settled contracts.
So, my point is that, there is an STT overhang on this physical settlement, which is there, because you're going to charge the same STT as a delivery-based stock would have. And that brings in a block with respect to people, taking a physical settlement of the stock at the time of expiry. Will that be a big hindrance, STT as a whole?
No, I haven't heard that to be a big hindrance in terms of...
we haven't seen much settlement happening in physical.
Yeah, so ultimately what ends up happening even in the commodity space today, while contracts are supposed to be all physically settled contracts, is that people square off positions prior to expiry, and therefore it's not that there are large volumes of physical delivery that is happening. But as a framework, it at least sends the right message that ultimately you have to take the risk that you may have to settle physically.
Vikram Limai of NSC. The Reserve Bank of India's one-time restructuring scheme for MSME loans for up to 25 crore could provide some respite to both lenders and small businesses. An India Ratings report suggests that the scheme will ease NPA recognition and credit cost pressures on banks and NBFCs while improving credit flow to the MSME sector as a whole. The report, however, warns of the damage it could do to credit culture. To talk us more about it, one of the authors of the report, Jindal Haria, Associate Director of Banks at India Ratings and Research, now joins us on the phone line. Jindal, thank you so much for joining in. What have you made of the RBI's move, and what kind of respite this is likely to have on the sector as a whole?
So there has been quite a noise made about the stress in the agri and the SME sector, and not without reason. And a lot of this started after demonetization, where cash flows were disrupted, and as things were just beginning to come back to normal, again you had GST. The government and the regulators both realized that, at least from a cash flow perspective, these are disruptive actions, and therefore the government as well as the regulators had a series of dispensations in the past also. But they were not as long duration as the current one that is announced, where they have a timeline of 5 quarters to restructure the assets, and once post restructuring there could be some principal moratorium and associated terms. So applicable to both banks as well as NBFCs. Given that last 6 months the credit flow to this segment through either the NBFC route or through bank route was tightened, it affects the liquidity of the SME sector as a whole. And this measure could ease up the liquidity of the SME sector, could make available the credit to the SME sector at least for next 1 to 1.5 years. And the cash flow could improve within the sector, and there could be some relaxation in the stress. However, banks need to be very careful when they restructure these assets, simply because they need to identify those MSMEs or MSME sectors where the issues are genuine and of Demon and GST, versus those sectors or MSMEs where the effect is structural, and the structural cash flows have been damaged and chances of them recovering is low. If the banks make this distinction, I think the restructuring could help the banks as well as NBFCs. NBFIs, as we know, the liquidity issues that have been coming up in the last 2 or 3 months. The lending from NBFCs has also come down somewhat to this segment, and this measure will, I think, improve the overall asset quality for the assets that could have gone bad in this calendar year.
Jindal, I know it's tough, but there's any way of understanding what is, the quantum of loans that could be eligible for at least restructuring? I think one way people are looking at it is that you calculate the loans that had taken the earlier dispensation of 180-day reporting instead of 90-day NPA reporting. Would that give us a measure of the quantum of loans that could be restructured?
You are right that, calculations are going to be tough, but I think that's the baseline number. Our assessment is that this is prospective. If you look at when these dispensations were available and from now, the stress that some of the SME segments are looking at has only gone up. So the numbers would be much higher than the quantum. I think it's around 10 or 12,000 crores that is under the dispensation, at least till now. The quantum of SME loans that could qualify for restructuring would be much higher. Just to give you a sense, if you take the SMA2 of a select public sector banks, the special mention 2 accounts, where the overdue is between 60 days and 90 days, which means they're very close to turning NPAs. The share of the accounts less than 5 crores in the SMA2 category has gone up from 20% to almost 60%. This gives you an idea of the SMA2 bucket is being constituted more by the SME agri segments than the corporate segment in the past.
No, that's an important point. Jindal, I have a small clarification though. So the circular said that you have to be in default on as of Jan 1, but not classified as an NPA. So isn't Jan 1 the cutoff date, or do you think that from here on also, if you are in default but not in that 90-day period or 180-day till that winds down, you can be eligible for restructuring?
I think the circular says that the asset has to be standard on Jan 1.
So if you're in default after Jan 1, you can still avail this, you think?
You will qualify for restructuring.
All right. Jindal, thanks so much for joining us. Appreciate you taking the time to give us a view on this. We'll see what actual numbers come out of this, but certainly, as everybody has said, it'll bring relief to the SME sector, some relief to banks, but from a credit culture perspective, as negative as it can get.
Let's move on. The government is likely to announce a relief package for farmers to ease their great distress ahead of the general elections this year. The centre is said to be studying options, including a cash handout. We spoke to the former Agriculture Secretary Siraj Hussain and Avik Saha of Swaraj India to understand which one of them would be most effective and viable.
I think administratively, the easiest option is to completely waive the interest on crop loans. Price deficiency payment, in my view, is completely ruled out because our administrative mechanism does not support that kind of intervention where every farmer's sale in the market is correctly recorded and the difference between market price and that sale price is paid. We have seen it failing in Madhya Pradesh. So that option is ruled out. Despite, the Raitu Bandhu in Telangana and despite the waiver of farm loans between 2014 and 2017, some 16,000 crores. Despite that, the TRS again promised waiver of farm loans, another 18,000 crores. So I would not have advised the Prime Minister to waive the farm loans, maybe the other two schemes.
Payments based on land leave out more than 50% of the farmers who do contract farming on leased lands, sharecroppers. So that's not a solution for half the people. So land-based payments are out. Waiver of interest is a very small component of the problem. Insurance will work well, thank you. But please don't pray for calamity so that I need that insurance.
In the crop insurance scheme, the basic challenge is to pay to the farmers hit by the calamities in time. Now for that, we need a much higher input of technology. So if I was to advise the government, I would not have advised them to completely waive the premium, because the premiums are already very low, actually 1.5% and 2% respectively for Rabi and Kharif. So they're already very low, and if the premiums are completely waived, there may be a number of problems relating to adverse selection, banks, insuring people, etc. What the scheme needs is a much faster settlement of claims, and for that we need some technological innovation which is not on the table yet. Another component of farm insurance which has been totally missing so far is the insurance for cattle. There are some people who say that the crop insurance scheme is a failure and all that, money is going to this company, that company. So let them suggest something to the government which will enable the government to ensure that the farmers are insured against loss of cattle, because that is not yet solved. How are we going to achieve that?
Hard, real look at guaranteeing incomes of farmers as a solution to the agrarian crisis. If you correct the price imbalance, if you make prices remunerative and you clean the slate once, because the loans that the farmers are currently mired into are because of the poor prices they've been receiving, then you have a somewhat composite solution. There needs to be a composite relook at the agricultural policy.
Right, moving on to news from the international markets. Apple CEO Tim Cook partially blamed a slowdown in China for cutting guidance for the first quarter, but the company's troubles in the world's second largest economy began even before trade tensions escalated. Mark Gurman of Bloomberg News reports.
On paper, it's almost entirely a China problem, according to Apple. That's what they're saying. We don't have, their data points, the data they're looking at, but according to them, this is 100% a China problem in terms of iPhone sales there. Bigger picture-wise, I think it's more of a global problem. I think they sort of price themselves out of many markets with these latest iPhone iterations. The iPhone XR, the low-cost alternative to the 10, 10s, 10s Max, is pretty much a couple $100 overpriced compared to the competition. Looking at China specifically, the pricing of the iPhone XS and XS Max is, double to 4 times, even more the pricing of some comparable phones from Vivo, Oppo, etc., that are being pushed so heavily by the carriers in China. So we're seeing the negative outcome play out in China. The fear is that this will spread to other regions. Right now, there's no reason to believe it will, but that is the long-term doubt that some investors and analysts have at this point after this disclosure.
Out of time on the show. Thank you so much for joining us today.
Lots more coming up. Stay tuned.